What if one of the most controversial price predictions in crypto wasn't built on pure speculation, but on a series of developments quietly unfolding right in front of us? Every time someone mentions the possibility of XRP reaching hundreds or even $1,000 per coin, the conversation usually ends with people calling it impossible. But what if the real discussion isn't about whether the number sounds outrageous? What if it's about whether the financial system itself is changing in a way that could completely redefine how digital assets are valued? Over the past few months, we've seen institutions becoming more active, tokenization accelerating, stablecoins expanding into new markets, and regulatory uncertainty gradually giving way to greater clarity. At the same time, something even more interesting has been happening behind the scenes. Large investors continue accumulating XRP, while many retail traders remain hesitant after months of volatile price action. That contrast raises an important question. What are these larger players seeing that many smaller investors might be overlooking? Today, we're going to separate excitement from reality, explore both the opportunities and the risks, and examine why so many investors continue to believe XRP could play a major role in the future of global finance. Some of the information we'll cover may completely change the way you look at XRP's long-term potential, so make sure you stay with me until the end, because the biggest piece of the puzzle comes later. Welcome back to We Are Cosmic, where we break down the latest XRP developments, market trends, and the biggest stories shaping the future of crypto. One of the biggest trends shaping the XRP market right now isn't necessarily the daily price movement. It's who's buying while everyone else is waiting on the sidelines. For months now, blockchain data has continued pointing toward increased accumulation from large holders, often referred to as whales, while many retail investors remain cautious after enduring a long period of uncertainty across the broader crypto market. That's an interesting contrast, because history has often shown that institutional and large-scale investors tend to position themselves well before major narratives become obvious to everyone else. Recent market data has highlighted growing whale activity alongside relatively cautious retail participation. While no one can know exactly why every large investor is buying or selling, it's difficult to ignore when significant capital consistently flows into the same asset over an extended period. These aren't isolated purchases happening over a few days. This trend has been developing for months, suggesting that some sophisticated investors continue viewing XRP as an attractive long-term opportunity despite short-term volatility. It's easy to understand why many everyday investors feel hesitant. Crypto has experienced dramatic price swings, unexpected macroeconomic events, regulatory uncertainty, and emotional market cycles that have tested even experienced participants. After months of sideways movement or corrections, many people naturally begin questioning whether the next major move will ever arrive. That kind of fatigue is common in every market cycle. But experienced investors often remind us that markets rarely reward maximum optimism at the top or maximum fear near important turning points. While no one knows exactly when momentum could return, the difference between retail hesitation and institutional accumulation has become increasingly noticeable. Another encouraging signal comes from growing investment products connected to XRP. Exchange-traded products and ETF-related investment vehicles have continued attracting significant inflows, with recent figures showing tens of millions of dollars entering XRP-focused funds during the month. Total cumulative inflows have climbed substantially, reflecting continued institutional interest even during periods when price action hasn't generated much excitement among retail traders. Institutional capital often moves differently than retail money. Large firms usually spend months evaluating infrastructure, regulation, liquidity, and long-term adoption before making meaningful allocations. They aren't typically chasing headlines from one day to the next. Instead, they're positioning themselves around trends they believe could become much larger over several years. At the same time, macroeconomic conditions continue influencing every financial market, including cryptocurrencies. Recent employment data in the United States showed weaker than expected job growth, while unemployment remained relatively stable. Although these reports don't guarantee any immediate policy changes, they have strengthened market expectations that the Federal Reserve could eventually move toward lower interest rates if economic conditions continue cooling. Why does that matter for crypto? Because lower interest rates generally improve liquidity across financial markets. When borrowing becomes cheaper and financial conditions become more accommodative, investors often become more willing to allocate capital toward growth-oriented assets, including digital assets. That's not a certainty, but historically easier monetary policy has often supported stronger performance across risk markets. This creates an interesting backdrop for XRP. On one side, macroeconomic conditions may gradually become more supportive for financial assets. On the other, institutional interest appears to be steadily growing beneath the surface. Neither development guarantees future price appreciation, but together they create a much more compelling picture than simply watching daily price charts. What's even more fascinating is that these market dynamics are only one piece of a much larger story. Beyond institutional accumulation and macroeconomic shifts, another transformation is beginning to reshape global finance itself. Governments, financial institutions, and major asset managers are increasingly focusing on tokenization, digital settlement, and blockchain-based infrastructure. And if that trend continues accelerating, XRP could find itself participating in a market opportunity that is significantly larger than many investors currently imagine. To understand why so many long-term XRP investors remain optimistic despite all the market volatility, we have to zoom out and look at where global finance is heading, instead of focusing only on today's price. The conversation is no longer just about cryptocurrency replacing traditional finance. Increasingly, it's about blockchain technology becoming part of the financial system itself. That distinction matters because adoption doesn't necessarily require banks and institutions to abandon everything they're already using. Instead, they're exploring ways to improve the infrastructure that already moves trillions of dollars around the world every single day. One of the biggest themes gaining momentum is tokenization. In simple terms, tokenization allows real-world assets like bonds, real estate, commodities, stocks, and even investment funds to exist as digital assets on blockchain networks. Instead of relying on slow, fragmented settlement systems, tokenized assets can potentially move faster, settle more efficiently, and reduce many of the operational costs associated with traditional financial markets. This isn't just an idea being discussed in crypto communities anymore. Some of the world's largest financial institutions and asset managers have openly acknowledged that tokenization could become one of the biggest transformations in finance over the coming decade. As more organizations invest resources into building tokenized financial products, blockchain infrastructure becomes increasingly important. That brings us to Ripple's broader strategy. While many people think only about XRP's market price, Ripple has spent years developing technology aimed at making cross-border payments faster and more efficient, while expanding into other areas of digital finance. Rather than focusing solely on speculation, the company has continued building products designed for institutional use. One of the most interesting developments is the continued expansion of RLUSD, Ripple's US dollar-backed stablecoin. Stablecoins are becoming an essential piece of the digital asset ecosystem because they combine blockchain efficiency with relatively stable value. Institutions generally prefer assets that reduce volatility during transactions, and stablecoins can help bridge traditional finance with blockchain-based infrastructure. What's particularly encouraging for XRP supporters is how activity surrounding RLUSD has continued shifting toward the XRP ledger. Over recent months, a growing percentage of RLUSD circulation has been associated with the XRP ledger rather than other blockchain networks. While Ethereum still plays a significant role in the broader stablecoin ecosystem, this gradual migration demonstrates that the XRP ledger is becoming increasingly relevant within Ripple's own expanding ecosystem. That may seem like a small technical detail, but it has much larger implications. Every time new financial products are launched on the XRP ledger, the network itself gains additional utility. More activity means greater familiarity among developers, financial institutions, payment providers, and businesses looking to explore blockchain solutions. Over time, expanding network activity can strengthen an ecosystem far beyond simple trading volume. Another important piece of this puzzle is the growing conversation around settlement efficiency. Traditional cross-border payments often involve multiple intermediaries, delayed settlement times, and higher transaction costs. Blockchain technology offers the possibility of completing settlement in seconds rather than days, potentially reducing both complexity and expense. International organizations have also been discussing how tokenized financial systems could improve efficiency by allowing trading, clearing, and settlement to occur almost simultaneously. While these conversations involve many different technologies and companies, not just Ripple, they highlight the direction financial innovation appears to be moving. Faster settlement, lower friction, and greater transparency continue to be recurring themes across the industry. Meanwhile, executives throughout the asset management world are becoming increasingly vocal about tokenization strategies. Many analysts now expect a significant percentage of global asset managers to publicly outline blockchain and tokenization initiatives over the next couple of years. That doesn't mean every institution will adopt the same blockchain or digital asset, but it clearly demonstrates that blockchain technology is becoming part of long-term strategic planning rather than remaining an experimental niche. If tokenization expands the way many experts expect, the demand for efficient settlement infrastructure could grow dramatically. That's one of the primary reasons XRP continues attracting attention. Its supporters believe the asset could serve as a bridge for transferring value between different currencies, financial institutions, and tokenized assets. Whether that vision reaches its full potential remains uncertain, but it's a far more substantial discussion than simply hoping for price appreciation based on speculation alone. Of course, infrastructure alone doesn't determine valuation. The next question investors naturally ask is whether all of this institutional adoption could realistically influence XRP's long-term price. That's where the conversation becomes much more complex, because understanding supply, liquidity, demand, and real-world utility paints a very different picture than simply looking at market capitalization. Now we arrive at the question that sparks more debate than almost anything else in the XRP community. Could XRP eventually reach triple-digit prices or even four digits? It's a topic that immediately divides investors. Some dismiss the idea without a second thought, while others believe it's only a matter of time. The reality is far more nuanced, and if we're going to have this conversation, it needs to be grounded in logic rather than emotion. The first thing to understand is that long-term XRP supporters aren't simply looking at today's trading volume and multiplying numbers until they reach a price target they like. Their argument is built around the possibility of utility-driven demand. In other words, if XRP were to become a widely used bridge asset for moving value across financial networks, its role would extend far beyond speculative trading. Think about the sheer scale of the global financial system. Every day, enormous amounts of money move between banks, corporations, governments, payment providers, and financial institutions across different countries. The total value flowing through cross-border payment systems reaches into the trillions of dollars over time. XRP supporters argue that if even a relatively small percentage of those transactions were eventually facilitated through the XRP ledger, demand for liquidity could increase substantially. That doesn't automatically translate into a specific price target, but it explains why so many investors focus on adoption rather than short-term market cycles. They believe the value proposition isn't based solely on scarcity or speculation. Instead, it's tied to whether XRP becomes an important piece of financial infrastructure. Another point frequently discussed is liquidity. If large financial institutions begin using XRP for settlements, they wouldn't necessarily purchase it every morning and immediately sell it every afternoon. Instead, many analysts suggest institutions could maintain dedicated liquidity pools to ensure fast and efficient transactions whenever needed. If that scenario develops, a portion of XRP's circulating supply could remain committed to operational use rather than active trading. While the total supply wouldn't change overnight, the amount readily available on exchanges could become smaller relative to growing demand. Basic economic principles suggest that when demand increases while available supply tightens, prices may experience upward pressure. The exact magnitude of that effect is impossible to predict, but the concept itself is straightforward. Supply is another important piece of the equation. XRP has a maximum supply of 100 billion tokens, and every transaction on the XRP ledger burns a tiny amount of XRP as a network fee. Those transaction burns are extremely small and are not expected to dramatically reduce supply in the near future. However, they do represent a gradual mechanism that slowly decreases the total supply over long periods. Ripple also continues releasing XRP from escrow according to a structured schedule. While some investors view escrow as a concern, others appreciate that the release process is transparent and predictable rather than unpredictable. This allows market participants to monitor supply dynamics with greater clarity than they might have in many other digital assets. Then there's the expanding ecosystem surrounding the XRP ledger itself. The discussion is no longer limited to cross-border payments. Developers continue exploring decentralized finance, tokenized assets, enterprise applications, stablecoins, and other blockchain-based financial services built on the network. Every additional use case strengthens the overall ecosystem because it creates more reasons for businesses and institutions to interact with the ledger. RLUSD could play an important role in that expansion as well. Rather than competing with XRP, many supporters see the stablecoin as complementary to the broader ecosystem. Stablecoins often provide price stability for payments and trading, while XRP continues serving its own role within network operations and liquidity solutions. As more institutions become familiar with Ripple's ecosystem through products like RLUSD, it may create additional opportunities for broader XRP adoption over time. Of course, none of this guarantees extraordinary price appreciation. Markets are influenced by countless variables, including competition, regulation, macroeconomic conditions, investor sentiment, technological innovation, and execution by the companies building these systems. Even the strongest long-term investment thesis carries uncertainty, which is why responsible investors always consider both opportunities and risks. Still, it's becoming easier to understand why many market participants remain optimistic. Their confidence isn't based solely on social media excitement or viral predictions. It's rooted in a broader belief that blockchain technology is gradually becoming integrated into mainstream finance, and that XRP has positioned itself as one possible solution within that transformation. But perhaps the most interesting argument hasn't even been discussed yet. Beyond payments, beyond stablecoins, and beyond institutional liquidity, lies an opportunity that some believe could reshape the entire financial landscape. If that next phase unfolds the way many industry leaders expect, it could significantly expand the addressable market for blockchain technology, and XRP may have a chance to participate in that evolution. When most people think about XRP, they immediately think about international payments. While that remains one of its most recognized use cases, many investors believe the opportunity extends far beyond moving money from one country to another. The bigger conversation is about the future of digital finance as a whole, and that's where the concept of network effects begins to play an important role. Network effects are relatively simple to understand. The more participants that join a system, the more valuable that system can become for everyone using it. We've seen this happen with the internet, social media platforms, payment networks, and countless other technologies. As adoption grows, additional users create more connections, more activity, and more reasons for others to participate. Supporters of XRP believe the same principle could apply to blockchain-based financial infrastructure. Imagine more banks joining payment networks, more financial institutions tokenizing assets, more developers building applications on the XRP ledger, and more businesses using blockchain for settlement. Each new participant doesn't just add another user, they potentially increase the usefulness of the entire ecosystem. That's one reason many investors pay close attention to Ripple's partnerships and enterprise initiatives, rather than focusing only on short-term price charts. Every new integration, payment corridor, or institutional collaboration provides another opportunity to demonstrate that blockchain technology can solve real-world financial challenges. Even if adoption happens gradually, each successful implementation helps strengthen confidence in the broader ecosystem. Cross-border payment corridors are a good example. Ripple has already demonstrated that blockchain-based settlement can reduce friction compared to many traditional processes. While global adoption is still developing, existing payment corridors have served as proof that this technology can operate in real-world environments rather than remaining purely theoretical. Then there's the rapidly expanding market for real-world asset tokenization. Analysts increasingly believe that trillions of dollars worth of assets could eventually be represented digitally on blockchain networks. Bonds, real estate, commodities, investment funds, and numerous other financial products may all become tokenized over time as institutions seek faster settlement, improved transparency, and greater operational efficiency. If that transition accelerates over the next several years, demand for reliable blockchain infrastructure could grow substantially. Supporters argue that the XRP ledger is well positioned to participate because it was designed with speed, scalability, and low transaction costs in mind. Whether it captures a large share of that opportunity remains uncertain, but it's one of the reasons long-term investors continue monitoring institutional developments so closely. Another factor that often enters the discussion is regulatory clarity. For years, regulation has been one of the largest uncertainties facing the crypto industry. Many institutions have preferred waiting on the sidelines until legal frameworks became more clearly defined before making larger commitments to digital assets. As regulatory environments continue evolving across different regions, many investors believe institutional participation could expand significantly. Greater legal certainty makes it easier for banks, investment firms, payment providers, and publicly traded companies to evaluate blockchain technology with greater confidence. That doesn't mean every institution will immediately embrace XRP, but clearer rules remove one of the biggest obstacles that has slowed adoption throughout the industry. Exchange-traded funds represent another potential catalyst investors continue watching. We've already seen how regulated investment products have influenced participation in other areas of the crypto market by making digital assets more accessible to institutional and traditional investors. If XRP continues moving toward broader availability through regulated financial products, it could introduce the asset to an entirely new group of market participants who previously had limited exposure. Still, it's important to remain realistic. Markets rarely move in straight lines. Even if adoption continues growing, there will almost certainly be periods of volatility, corrections, and unexpected challenges along the way. Long-term investing has always required patience, and cryptocurrency remains one of the most volatile sectors in finance. This is exactly why experienced investors often focus less on predicting the next week's price action and more on evaluating whether the long-term thesis continues strengthening. Are more institutions entering the space? Is blockchain adoption increasing? Are developers continuing to build? Are regulators providing greater clarity? Those questions may ultimately matter far more than what happens during any single trading session. All of these pieces begin fitting together into a much larger picture. Whale accumulation, institutional investment products, tokenization, stablecoin growth, regulatory progress, and expanding real-world utility all contribute to the conversation surrounding XRP's future. None of them guarantee success individually, but together they help explain why optimism remains strong among many long-term holders, despite ongoing market uncertainty. As we bring everything together, it's easier to understand why XRP continues generating so much attention, even during periods when the market seems quiet. The conversation is no longer centered only on cryptocurrency as an investment. It's increasingly about whether blockchain technology can become part of the next generation of global financial infrastructure. If that transformation continues, assets with genuine utility could find themselves in a much different position than they are today. We've looked at several pieces of the puzzle throughout this video. Large holders have continued accumulating, while many retail investors remain cautious. Institutional investment products have attracted meaningful capital. Ripple has continued expanding its ecosystem through initiatives like RLUSD, while the XRP ledger remains part of broader discussions surrounding tokenization, cross-border payments, and digital settlement. None of these developments guarantee future price appreciation, but they do show that the ecosystem continues evolving rather than standing still. Perhaps the biggest takeaway is that XRP's long-term investment case is based on utility. Supporters aren't simply hoping that excitement alone will drive prices higher forever. They're watching for measurable adoption. They're paying attention to whether financial institutions integrate blockchain into their operations, whether tokenized assets become more common, whether liquidity solutions expand, and whether regulatory clarity encourages broader participation from traditional finance. That also explains why price predictions vary so dramatically. Some analysts remain conservative, expecting gradual appreciation as adoption grows over time. Others believe XRP could eventually reach triple-digit prices under highly favorable conditions. Then there are those who project even more ambitious scenarios, including four-digit valuations, based on assumptions involving massive institutional adoption, significant reductions in liquid supply, and widespread use of XRP across global financial networks. It's important to remember that these projections are scenarios, not guarantees. Reaching prices like $1,000 would likely require extraordinary levels of worldwide adoption, sustained institutional demand, favorable regulation across multiple jurisdictions, and a financial landscape that embraces blockchain technology on a scale we've never seen before. Those conditions are possible to discuss, but no one can say with certainty that they will happen or predict exactly when they might occur. Markets are influenced by far more than technology alone. Global economic conditions, central bank policies, geopolitical developments, investor psychology, competition from other blockchain networks, technological innovation, and regulatory decisions all play significant roles in determining how digital assets perform over time. That's why successful investors often remain flexible. They stay informed, adapt as new information becomes available, and avoid becoming emotionally attached to any single prediction. At the same time, it's difficult to ignore how much the conversation around blockchain has evolved over the past several years. What was once dismissed by many as an experimental technology is now being explored by governments, multinational corporations, financial institutions, and some of the world's largest asset managers. Tokenization is moving from theory to real-world implementation. Stablecoins continue expanding their role in digital finance. Cross-border payment innovation is accelerating. These aren't isolated trends. They're part of a broader shift taking place across global finance. Whether XRP ultimately becomes one of the biggest beneficiaries of that transformation remains one of the most fascinating questions in crypto. The answer won't come from social media debates or sensational headlines. It will come from continued execution, growing adoption, technological development, and real-world usage over the years ahead. For me, that's exactly why this space remains so exciting. Instead of focusing only on today's price candle, I prefer watching the bigger picture unfold. Every new partnership, every institutional initiative, every regulatory milestone, and every advancement in blockchain infrastructure adds another piece to the story. Some developments will exceed expectations, while others may take longer than anyone anticipates. That's simply how innovation works. If there's one thing history has consistently shown, it's that transformative technologies rarely achieve mainstream adoption overnight. They evolve step by step, often with periods of skepticism before wider acceptance begins. Whether XRP follows that path is something only time will reveal, but it's certainly a project that continues giving investors plenty to watch. I'd love to hear your perspective. Do you believe XRP's greatest growth is still ahead, or do you think the market has already priced in much of its long-term potential? Share your thoughts in the comments below because the discussion is always one of the best parts of this community. If you enjoyed today's breakdown and want more in-depth coverage of XRP, Ripple, institutional adoption, crypto market trends, and the future of digital finance, make sure you hit that like button, subscribe to We Are Cosmic, and turn on notifications so you never miss our next update. Thank you for watching, and I'll see you in the next video. This video is for educational and entertainment purposes only and should not be considered financial advice. Always do your own research before making any investment decisions. Cryptocurrency investments involve risk, and past performance does not guarantee future results.